All right, that was Federal Reserve Chairman Jerome Powell live after announcing the central bank will raise interest rates for the first time in 3 years. This is all about Bitcoin, a show dedicated to all things questions and markets related to Bitcoin, little b for the currency, and Bitcoin, big B for the network, a collective journey to understand, apply, and use this innovation, all Bitcoin, all the time. I'm your host, Christine Lee. Let's have a live look at Bitcoin right now. The CoinDesk Bitcoin price XVX index currently at $39,892. Bitcoin is up just over 1% over the past 24 hours, along with the rest of the crypto markets. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as the leader in crypto news, events, and data. So yes, the top story of the day is Fed Day, a widely predicted rate hike of about 25 basis points. Federal Reserve raising interest rates for the first time in 3 years. More rate hikes are expected to come throughout the year and into next year. Let's just dive right into it. Our first guest, Marc Ostwald, Chief Economist and Global Strategist at ADM Investor Services International. Hello there, Marc. Thanks for joining us.
Hello.
So some of the things I noted, Fed Chair Jerome Powell saying, tangled supply chains due to the war by Russia and Ukraine. Financial markets have already priced in rate hikes. The Fed sees core inflation this year at 4.1% and overall inflation up by 4.3%, which is more than economist expectations. Your takeaways?
Yeah, I think my takeaway is what the market wasn't really prepared for was the projections for 2023, which envisage the Fed funds rate going above the so-called neutral rate of 2.5% by about 40 basis points. So, basically the Fed's saying we are basically going to try and get on top of this. Nevertheless, if you look at the dot plot, it's still talking about 25 basis points per meeting, which is relatively speaking aggressive, but it's not talking about anything more than that. I think really where there's a bit of triumph of hope over adversity is the GDP forecast has been revised down very sharply to 2.2 from 4. Quite natural given all the uncertainties that we've got with continued supply chain problems and indeed the war in the Ukraine. But it's making an assumption here that basically there isn't going to be a major hit to growth which will take us completely off course. And that, I would say, is basically a real, that's more a hope than likely to be a reality. The things that are going on at the moment in the world, particularly the disturbance to all supply chains, are just going to are going to make things that much more difficult.
So with the vast money printing that has been going on over the past couple of years, the pandemic, a war in Ukraine, slowing down supply chains, high inflation, are we headed toward a global stagflationary recession?
I don't think we're necessarily headed towards a stagflationary scenario simply because we've still got a lot of pent-up demand out there. We haven't actually managed to rebuild the inventories which were lost through the lost production during the pandemic yet. And there is still a lot of pent-up demand, but we're going to be struggling to actually meet that pent-up demand. And that, in a certain sense, underpins growth, even if the recovery per se is going to be somewhat slower. But we are going to be in an inflationary environment, and there's no question about it. And the biggest threat, I think, to any economy in the world is the fact that the inflation that we've got all comes in the non-discretionary area. Food, energy, and indeed housing. The housing part is something the Fed and other central banks can do something about because they're the ones who actually blew the big housing bubble that we've seen. It's not just in the United States, it's pretty much any country that one cares to think of, even a conservative country like Germany. But that's going to impinge on consumer spending. And if we get another rally in oil prices because perhaps things don't turn out as well, perhaps the underlying fundamentals of the oil market, like weak refining capacity, will basically just continue to impinge it. But that impinges on household spending. And for the time being, that's the biggest risk, that we actually see more of a consumer spending recession as a result of all this inflation that we've got.
I just want to spend a moment on how the markets are reacting. Bitcoin is up. U.S. stocks are as well. There's a surge in U.S. government bond yields. Explain the market reaction.
I think the market reaction is, I wouldn't call it violent. The only real violent reaction, a substantial reaction, has come in the Eurodollar curve, with markets basically marking down Eurodollars by something between 15 and 25 basis points, depending on which part of the curve further out. And that's really where the pain's being felt. And also we've got a flattening of the yield curve, quite significant one, which in principle basically tells us that the market is saying, well, if the Fed's going to tighten that much, then their GDP forecasts look rather optimistic. So I think the biggest risks that we've got at the moment, and this is the thing that where there's a disconnect between what's showing up in equity markets with a modest recovery from the initial knee-jerk down, is we've seen credit spreads widening. And at some point, equity markets are going to have to take note of the fact that actually not only have we seen treasury yields rise, but we've also seen credit spreads widening. So if you get a 25 basis point rise in 10-year treasury yields, what you're seeing is on top of that another 25 points in credit spread widening. And that's bad news basically for companies who need to refinance, particularly in an environment where money markets are already starting to show the stress from the war in the Ukraine.
Mm-hmm. Add to that, Fed Chair Jerome Powell expects up to 7 rate increases this year. What is the significance of that? And when do you feel that the rate increases will start to have an effect in curbing rising inflation?
Well, monetary policy is basically geared by the interest rate instrument to blunt demand. Now, the problem we've got is this isn't a demand-side inflation problem. There is a reasonable demand, as I was talking about earlier, in terms of the pent-up demand, which will fade as we gradually get those supply chains working again, even if that takes a longer time. But it can't actually solve anything to do with supply-side problems in the energy market. It can't deal with anything to do with all the disturbances that we're going to get to agriculture. So the risk is that at some stage it's the inflation itself rather than monetary policy which really does the most damage, the most damage to the economy. And that's really where my problem lies. That we're actually if you've got supply side problems, the best tools for basically dealing with them are sunsetted legislation, i.e. legislation which has to be reviewed on a regular basis to try and curb some of the impact of energy price rises above all on consumers. You're not going to curb the inflation by raising interest rates. All you'll do eventually is kill demand.
Mm-hmm. And finally, how do you expect this to impact Bitcoin?
Well, I think at the moment, really, the story around Bitcoin is more about, if we're fracturing the global system due to this in Ukraine and with excluding Russia effectively, largely from many parts of the global payment system, people are going to be looking at alternatives, and Bitcoin will certainly be one of them. The problem is, obviously, some of the interest in Bitcoin is far more speculative. And at the moment, I think all we've got is an extremely high volatility environment. And I cannot see how a high volatility environment is particularly good for that, because it basically, if we get rising real yields, and at the moment they're not really attractive, then the alternative assets such as gold, such as Bitcoin, basically become less attractive because the opportunity cost of investing in low yielding assets becomes, the opportunity cost of higher risk assets becomes higher, and the more defensive assets become slightly more attractive, though not that much more attractive. So we're still talking about an end rate. The Fed's projecting 275. people are still going to be looking at assets like Bitcoin, like high yield credit, basically as an alternative, because what they're going to get in money markets or in bonds is particularly unattractive, and particularly in a rising interest rate environment, particularly long duration assets are not attractive at all.
Mm-hmm. On that note, we are seeing that gold is slipping on that Fed rate hike announcement. And at the same time, Bitcoin is going slightly up. So not acting like the digital gold that it's said to be for the moment, but we'll see in the next couple of days. Marc, thank you so much for joining us. Appreciate your analysis. That was ADM Investor Services International Chief Economist, Marc Ostwald. Coming up, more BTC price analysis with CoinDesk's very own Damanick Dantes.
The world's fastest growing crypto app.
The Bart Simpson price pattern spotted early Wednesday as Bitcoin saw a quick rise and fall in a thinly traded market. Bitcoin spiked from just above $39,000 to nearly $42,000 in 30 minutes, only to fall back down, according to CoinDesk data. FX Pro telling CoinDesk the sudden rise perhaps stemmed from stop orders on short trades and ran into stronger selling pressure. Bitcoin has recently seen multiple bull failures above $42,000, the latest from today's Asian session, likely resulted from the activity of market makers, which have a tendency to be systematically short the market, according to CEC Capital. Broadly speaking, trading activity has cooled in recent weeks, as evidenced by the decline in daily trading volume seen there on major exchanges. As such, relatively smaller trade sizes can have a notable impact on the market. All right, joining us now to discuss BTC price analysis is CoinDesk Markets analyst Damanick Dantes in New York. Hello there, Damanick. Thanks for joining us. Good to see you as always. All right, what do you make of the Bart Simpson pattern? Certainly a lot of volatility out there.
I have never heard of the Bart Simpson's pattern, but yeah, it is spiking through. I think this is what you get when you have very low volume, very low volatility, is you tend to get these extreme spikes. And it's also very typical of a bear market. You have extreme or wild bear market traps of sorts where sellers and buyers are rushing to exit and they can't meet the other party of the trade. So that creates these like wild moments that we're seeing. We also saw that option traders have been positioned for higher volatility on the short end. And so that's kind of why you're seeing that. But overall, a lot of the sentiment has been pretty neutral. So we're in this chop zone between 30 and 40K for now.
Yeah, talk to me a bit about that volatility. You know, we're seeing low volumes, risk is off the table, it seems. Is the market kind of in a wait and see mode?
Yeah, they were for the past month. I mean, it's just been very quiet, but you've been seeing some sort of a defensive tone within the options market, at least. There's been a demand for puts, especially within ETH. A lot of the traders are seeing that. And then this chart just shows that realized volatility, which is, you know, the real volatility, has been pretty much dampened over this past month. But then implied volatility from the options market has been significantly elevated. So that shows that traders have been pricing in the potential for wild price swings over the past week, at least. And that was definitely heading up to today's announcement from the Fed. So going forward, you know, a lot of the traders, especially QCP Capital from Singapore, has been saying, you know, they expect the vol curve to steepen. And that just means longer dated options would be a little bit more volatile, or longer dated prices will be a little bit more volatile, whereas short-term prices activities are discounted. And, you know, the options market is placing about a 50% probability of Bitcoin being above 37 or 38K over the next month. So your odds are pretty much balanced.
Interesting. Taking a look at Bitcoin's performance compared to other cryptocurrencies, what are we seeing there?
Very interesting. So very much correlated. And this is pretty interesting over like this market volatility at least, it's very hard for investors to find diversification. You look at crypto as a portfolio, and typically you look for Bitcoin as like the less volatile crypto, and then altcoins like ETH as the more volatile cryptos. So in a bull market, you get much more bang for your buck when you go to the altcoins versus ETH. And in bear markets, you tend to seek some safety and reduce your exposure to risk, that being the altcoins. But when correlations are rising, everything is moving in tandem. So it's very hard to diversify and mitigate volatility risk in your portfolio. So that's kind of what we're seeing here. And when correlations rise, this tends to benefit Bitcoin's dominance, which we've been seeing that dominance ratio, Bitcoin's market cap relative to the total crypto market, increasing over time. And that's also very typical in a risk-off environment. So the risk sentiment is pretty much reduced. Correlations are higher. Volatility is very low, but with the potential of a spike going forward.
All right, we've been talking a lot about risk off, in this environment. What's the near-term bull case for Bitcoin?
I would probably say, some relief rally of sorts, especially from equity markets. Yesterday's market wrap, I showed the drawdowns, which is the percentage decline from peak to trough, or just a percentage decline from the recent high. It's pretty extreme, but not as extreme as what we saw in previous sell-offs, that being 2020. So there's definitely some room for extra volatility and probably, some settling out of sorts. So what you might just see is a short squeeze. And that just means that we'll break out of this range perhaps. But the upside is very much limited. When you look at the monthly chart from the technical perspective, momentum has dipped negative, and that pretty much gives you about 2 to 3 months of downside. So we're not there yet, and we haven't seen a lot of those indicators reach extreme oversold that would, ignite some buying pressure. And your guest earlier, very spot on with the opportunity cost of holding risk assets versus defensive assets. When you're in a high yield or a rising rate environment, especially when real rates rise, your risk assets in a portfolio tend to create some volatility, and you want to decrease that as much as possible to generate some sort of outsized return. Return spectrum going forward is very much lower than the norm of what we've been seeing when we're in an accommodative monetary environment. So definitely going forward, a lot of these asset managers, traders with big bucks want to reduce some risk.
Excellent. Thank you for breaking down the markets, Damanick. Always clear and concise. That was CoinDesk markets analyst Damanick Dantes. All right, that's it for All About Bitcoin. I'm your host, Christine Lee, and we'll do it all over again tomorrow at 3 o'clock in New York. Also, join us tomorrow morning at 9 a.m. for our first mover. You're watching CoinDesk TV.